on this episode of Indiana Education Insight.
I wanted to educate people in a different way, and so got into finance and into the financial planning, advisory realm, and really feel like it was a pretty easy transition because you're still doing a lot of the same things.
Every week, the Indiana Association of Public School Superintendents is taking you inside today's Indiana education collaboration and tomorrow's education trends. We're staying on the pulse of public school innovators throughout Indiana and beyond. Join our conversation and contribute to our upcoming topics at iapssin.org/podcast. Here's your host, Dr. J.T. Koopman.
Thanks for joining us on today's episode of Indiana Education Insight. I'm Dr. J.T. Koopman, Executive Director of the IAPSS. This podcast is being delivered by our IAPSS team, produced by our friends at Edge Media Studios. As Executive Director of IAPSS, I'm excited to bring you this weekly show where we feature Indiana education innovators from all over our great state, from students to superintendents. We'll also be talking to higher education leaders and educators at the state level as we work together as proactive public education advocates. That's why IAPSS is here and why we're proud to bring you this show. Every week, we're talking about trending topics in the public education space while bringing in Indiana education innovators to hear their perspective. As with any organization, it takes great leadership to be successful, and that is one of the main missions of IAPSS, developing great school district leaders. It is always great to have experienced and passionate educators joining this show. So let's get started with today's conversation.
Topics and trends in Indiana education.
Today's guest is Mr. Josh Shelton, a certified mortgage planner with Congressional Bank. Previously, Josh was a teacher and a coach, and his mother is an assistant superintendent. Josh has made several presentations as well as numerous public speaking engagements. So he has been instrumental in shaping the conversation about Indiana public schools and has the ability to look at education from various lenses, which is very important. Of course, he has been a tremendous asset to public education in Indiana. Let's find out how he views the issues in Indiana public schools. Well, it's my pleasure to welcome Mr. Shelton, and we're thrilled to have you on today's show. If you could start out by just sharing a little bit about yourself and how you got to be in the position that you're in and the various roles that you have served.
Sure. Well, first of all, Dr. Koopman, thank you very much for having me here today. I appreciate it. It's an honor and a privilege. I think like you mentioned, started off my family are educators. My father is a retired teacher, was a teacher and a coach for 30-some years up in Fort Wayne Community Schools. As you mentioned, my stepmother is assistant superintendent. My wife is a teacher here in the Indianapolis area. Her sister is a teacher. Her mother and other sibling is also a teacher in multiple capacities. And so I come from a family of educators, and I'm passionate about the role that educators play. Myself, I started off as a teacher 2005. I actually was a physical education teacher at the elementary school level.
Okay.
And worked in various teacher settings, elementary, high school, university level, throughout the last almost 10 years, so up until 2016, and decided that I wanted to educate people in a different way. And so got into finance and into the financial planning, advisory realm, and really feel like there's a pretty easy transition because you're still doing a lot of the same things.
Sure.
currently work on the mortgage side of things, and which is a little bit different because working in financial advising, you're working on the asset side of the balance sheet, whereas on the mortgage side, you're primarily working on the liability side.
Sure. Well, that you've obviously, with a family of educators, and for you to make the transition from being a teacher into your current role, I found that to be very intriguing. And in the conversations that we have had, it certainly makes sense because this is a kind of a different model than we've heard about in other things. And that's one of the primary reasons that I wanted to bring you on today's show, is that this could be an asset for our educators that listen to this program to learn about what you do and why you do it and how you do it. So you've had kind of an interesting background, and so I'm interested to find out from you, based on your experiences, why do you think it's important for educators to have financial wellness education, and how do we get educators involved in learning about financial wellness?
Yeah, so I think I was telling you before we got started here that I'd listened to the podcast from Tom Mellish, and just listening to the topic on teacher retirement, the fact that we are transitioning from a defined benefit to a defined contribution plan.
Right.
The fact that I think, if I remember right, he said around 75% of income will end up being funded in retirement. So that leaves a gap of 25%. So from that standpoint, when you consider what the mortgage, or how the mortgage plays a role into your overall financial plan, most people, their mortgage takes up 25 to 35% of their monthly expenses.
Sure.
Some people even more.
Right.
So when you start to think about it from that perspective, you realize that the mortgage plays a significant role in the overall financial plan, and it affects every single aspect of a person's plan.
Right.
So what we set out to do was to figure out, okay, well, how do we help people in terms of structuring those mortgages? What strategies do we use to not just only help them buy a home, but also to help them secure their financial future in the process?
Sure.
Right. And so I think that it's important that educators do become educated on financial wellness, not even just only as it pertains to the mortgage side of things, but holistically. And, when I was in education, a lot of times we did have advisors that would come through the schools.
Sure.
And they offered some great insight. But I don't know that it's utilized enough today. I don't know that we're providing enough access for our educators to truly get the financial wellness education that they need.
Right.
Because it's going to play a significant part in their life as they continue to grow in their career. And those that are getting ready to retire, they need to have a plan in place right now.
Absolutely. Yeah, and and I don't think that young teachers in particular, and to be honest with you, many others, even if they're more experienced teachers, really think deeply about where they're going to be in 20 years or 25 years or 30 years, and then start setting aside. And the whole idea of the compounding interest and all of those kinds of things is a fascinating thing to me that you understand much better than I. But I think it's important for you to talk about financial wellness and planning with educators. And there are a lot of school districts, unfortunately, that don't have those financial planners and others that are coming through the school district. And again, even if they're there and they're seated, for instance, in the teacher's lounge, and then teachers can come to them, not enough, I think, take advantage of that. So that was another reason that I thought it was interesting and important to have you on today's show for those reasons.
Sure. Yeah, so from a financial wellness perspective, obviously you want to make sure that you have a plan in place for your cash flow management. Most are going to have some debt. debt obligations, so you're going to want to have some sort of debt management plan in place as well.
Right.
Then you also want to look into, obviously your retirement. But quite honestly, retirement is a small piece of it.
Sure.
Right? You're going to want to make sure that you have a will in place. You're going to want to make sure that you have a plan in place to be the most tax efficient that you possibly can with the money that you make.
Right.
So there are a lot of aspects that I think most people do not fully take into consideration when they start to think about their overall financial plan. I think most people just run automatically to retirement, savings, and investing. And investing is an important part of it, but it's not everything.
Sure.
Right.
So, pardon me, how can we engage our educators around the value of financial wellness, and how does a person's mortgage fit into their financial planning?
Yeah, sure. So I think kind of going back to the question that you asked about how do we get teachers more educated on this process, on this perspective. Number one thing is I would love to see administrators. I don't know if you can require teachers to attend financial planning sessions during their plan period or lunch,
Right.
but I'd like to see us come up with a process that we don't just sit advisors in the cafeteria and hope that a teacher is going to walk by. I'd like to see us have a process that's more engaging
Right.
between the advisor and the educators. The other thing, too, is just making sure that the importance of people working with a fiduciary. And that's...
Explain fiduciary.
Sure. So in a nutshell, that means that the advisor is always going to have the client's best interest at stake.
Sure.
Right? A lot of people say, well, shouldn't they do that anyways? Yes, they should. But not everyone is held to a fiduciary standard. And so it's important that when you do hire a financial advisor, that they are a fiduciary.
Right.
And it doesn't necessarily mean that they're only going to be fee only, meaning they only are going to charge a defined fee based on your assets. There are plenty of fiduciaries that work under a fee-based model as well. But nonetheless, make sure that when you work with someone that it's not just simply a salesperson cloaked in the financial advising title.
Right.
Right.
Yep.
So engaging educators in this process, and what is mortgage planning? So first of all, mortgage planning is really looking at this through the lens of how does the mortgage fit into my overall financial plan? How can we structure a mortgage? What type of mortgage strategies can we use to make sure that whatever home we're going to purchase, the financing that we're going to seek and receive actually fits into our overall financial plan?
Mm-hmm.
And sometimes that scares people when I say that, because they think that I'm going to say, well, you shouldn't buy this home, where quite honestly, that's not the intent at all. Our goal is to help you receive financing to purchase your home.
Sure.
But we want to do it in a way that makes sense.
Right.
So our mortgage planning process has 4 steps. So step number 1 is just an initial conversation where we're just simply gathering information, getting to know people,
Right.
getting to know, building a relationship and getting to know about their family, their recreational interests, what they do for work. And then lastly, what goals do they have? A lot of people think that the goal is to buy a home. We talk a lot about the benefits of benefits, meaning the benefit of home financing is buying a home.
Mm-hmm.
The benefit of the actual purchase of a home is being able to meet the other obligations or goals that you have in your financial plan.
Yep.
So it's very important that people start to look at this through the context of that this is an investment, hopefully, And the ironic part about that is that most people, when they go to buy an investment, who's the first person that they're typically going to go to when they want to buy an investment product? Typically, it's going to be their financial advisor.
Mm-hmm.
The irony in the home buying process is that most people will tell you my greatest investment or my greatest asset is my home, and they'll never think about going to talk with their financial advisor before making a home purchase. And so what I am trying to do is create that paradigm shift where people, when they consider buying a home, the first person that they contact is going to be their financial advisor.
Right.
And let's make sure that we are structuring the mortgage in a way that allows for us to meet all of the financial goals and objectives we've set forth.
What now? This is a little bit off script, so
Sure.
I apologize. But since we're talking about mortgages and mortgage plannings, the term house poor comes up.
Yeah.
Now, what does that mean in your world?
Yeah, so simply put, house poor is when your mortgage cost is too high in comparison to your other obligations, right? So if you have a monthly payment that does not allow for you to reach your other financial goals and objectives, essentially you're house poor.
Right.
And so simply put, that's the best way to answer that question. So that is something that we take into consideration, and I think so. Going back to what is mortgage planning, so that first conversation is just simply an initial conversation where we're getting to know people. The second step in our process is where we start to analyze and evaluate their options based on the information that we gather. And one of the things that we look at is we want to make sure that we're not making someone house poor.
Right.
Right.
Yeah.
And so in our initial process, we actually provide a mortgage planning questionnaire. The mortgage planning questionnaire is going to ask a host of questions pertaining to do you have life insurance? Do you have disability coverage? Are you currently contributing to your 401k plan? Are you maximizing your 401k contributions?
Mm-hmm.
Do you have small children that you're wanting to start saving for college education, right? So we're looking at all of the different things. Do you have an emergency fund?
Mm-hmm.
It amazes me how many people are willing to spend all of their cash, get into their house, and have nothing left in case something goes wrong.
Right. Yep.
So we're looking at all of those different scenarios, hoping that we can figure out a way that we can help people along that path
Sure.
to secure their financial picture. So step two is, like I said, is analyzing and evaluating their options. Step three is where we develop and implement that plan. And really what that means is I'm going to have a second conversation with our client, and I'm going to lay out their options. I'm going to educate them on the different options that they have available.
Mm-hmm.
If they have an advisor, I'm going to collaborate with their advisor as we lay out the options. And then once they're educated on the different options that they have available to them, they can make an educated decision
Sure.
on what fits best for them.
Right.
Right.
Yep.
And so then step four is where I get pretty excited in this process, because step four, we actually monitor our clients' mortgages on an annual basis, and we have a discussion with them every year, which is a 10 or 15-minute conversation where we're simply going to check to make sure that the mortgage strategy that we've put into place still fits their lifestyle needs.
Okay.
So that's a unique, I believe it's a unique process. It's a unique value that we provide to our clients that you're not going to see very many other places.
So, generally speaking, as they go through their career path and their earnings increase, then those conversations over time are going to develop into different conversations about planning for the future.
That is correct. Yeah, so just to kind of lay out a scenario, if we had a client that they have a increase in income, we may have a discussion about prepayment, which means that you're going to pay more per month on your principal, right, to reduce the principal and build equity in your home.
Sure.
So that's, that could be one fairly simple scenario.
Right.
A lot of times we get questions about, well, is that because you're hoping people are going to refinance? Quite frankly, we don't have as many opportunities to refinance, particularly given that we're in a rising interest rate environment,
Right.
as what people would think. That's not our goal, to have the annual mortgage review. The goal is to make sure, like I said, that as people's lives evolve, as situations change, that the structure and the strategy still fits.
Right. Yep, that makes sense. So what are the current market trends in real estate and mortgages? We were talking a little bit about that, rising rates. So what are the current trends?
Yeah, from a mortgage perspective, well, the trend that we're in, like I said, we are in a rising interest rate environment. Typically, we're seeing rates anywhere between 4 and 4.5%. We're even getting up into the 4.75% area. A lot of that has to do with we've got some unrest economically and politically, not even just in the United States, but globally.
Sure.
So how rates work is typically if the stock market is good, rates are going to go higher. If the stock market is doing poorly, rates are going to go lower. And so that's a very easy way. Typically, when I explain rates, that's how I explain them. All you need to do is look at what the stock market is doing, and also too what our economic growth looks like, and that will give you a pretty good indication of which direction rates are headed.
Well, given the last statement that I had on my stock market portfolio, interest rates should be going down. So,
well, the thing is that was only one quarter.
right.
Because I'm sure you're talking about a quarterly statement that you received. I would bet that if you looked back many quarters since then, you're probably doing pretty well.
Yeah.
From a real estate perspective, we're in a very we're in a hot market, but we're in a very unique market. 2008, 2009, when we had the recession and we had the housing crash, builders stopped building.
Mm-hmm.
And so what we've seen as we've moved forward now is that we have a shortage of inventory.
Right.
So what that means is that prices have gone higher. I know for a fact that there was a house over on the northeast side of town in a desirable location that was priced at $10,000 above the comparable houses in the area. There were 32 offers on that home, and that home was sold for $15,000 above the asking price. And I think that really underscores the mortgage planning process. That really underscores having a financial team in place and a team of advisors in place, because really what it's doing is it's forcing people to go above and beyond probably what they want to spend. It's putting extreme amount of stress on them financially.
Right.
And the market is dictating that you have no choice. If you want to buy a home, you're going to be in a multiple offer situation. You're going to have to compete against very strong buyers.
Right.
And you're going to probably end up paying above the asking price.
Sure.
So if you don't have a plan in place, if you don't know how that price fits into your overall objectives, you're putting yourself in a difficult situation,
Right.
possibly.
Yep. And not to have an expert like you on your side, I think, is erroneous.
Sure.
And you understand the market, you understand what it's going to take, and I think this whole financial planning piece to a mortgage, especially in a market like this, is very, very important. So I think it's important for our audience to understand why you're here today.
Sure.
It's to help people,
Right.
and to help them better understand what they might be facing in their future. So,
But if you don't mind, just to interject real
Sure.
quick, a couple of things that I think people really need to do, especially our educators that are listening to this, if you're considering buying a home, most people wait too long to start the finance process. Most people are going to contact a realtor and then contact a lender.
right,
In hopes of getting pre-approved that day,
right,
right? When really what they should be doing is they should be starting this process 6 months out.
right,
And because a couple of things need to be in place if you're going to be the strongest offer on the house. Number one, you need to be in position to be able to have a good credit score.
Sure.
Right. Number two, your liabilities need to be in line with your income. So we call that the debt to income ratio. So
Right.
basically it looks at how much do you make versus how much do you owe.
right,
And so those two things have to really be in place so that we can get you qualified and make you as competitive and as strong of a pre-approval offer as we possibly can.
right, yep,
So if you're waiting till the day that you're deciding you want to go look at a house, well, you're not going to have time to make any improvements to either one of those two areas.
yep, yep.
So,
Well, and that was part of the question that I was going to get to at possibly. I refer to that as strategic planning,
sure.
and we all have to, or we all should have, some form of a strategic plan. And you mentioned 6 months, and so the same is, I would assume, is true of how long are you planning to stay in that home. Does that have anything to do with it?
Yeah, absolutely. I mean, that goes into the type of strategy that we're gonna develop and implement. Pretty common scenario is a younger person that is looking to buy their first home. They'll tell me, well, starter home, probably going to be in it, 3 to 5 years.
Right.
Probably has some student loan debt, so it's going to probably put them in a position to be an FHA buyer, which is one of our programs that allows for a little bit higher debt to income ratio. The issue with only wanting to be in a home 3 to 5 years and only putting, a small down payment, such as a FHA 3.5%, is if you're wanting to sell that home, are you going to have enough equity in that home to be able to at least break even when it comes time to sell?
Right.
Right. So, if we can be in that case, might be worth considering being a conventional buyer, putting down more than 3.5%, so that we can build up equity quickly, so that when we want to sell, we can go ahead and sell and break even or possibly make a profit.
Sure.
The other issue, or the other option there too, is maybe you want to do some prepayment. That's where the mortgage planning process and the annual review comes in every year, because a young person, hopefully they're going to see their salaries increase, and they're going to have some more disposable income. They're going to be able to prepay, and we can build up equity faster.
Right.
Right. The flip side of that is, because I get this question quite a bit about, should I put down 20% or 5%? Right. We're somewhere in that range. Most people think for a conventional loan, you got to put 20% down. That's not the case. We have a program that's 3% down, conventional program.
Right.
But when you're having that discussion about 20% down versus a smaller down payment, the question becomes, like you just asked, how long do you plan to live in the home?
Right.
Even how long do you plan to have the loan?
Yep.
I mean, because that can dictate some other things as well.
Sure.
but it's a very common question that gets asked that you have to put a little bit of thought into, because if you're putting 20% down and then you're left with no available cash for an emergency, we may want to consider putting less down.
Right.
But if you're in a place where cash flow is the real issue with your financial situation, then we may want to put 20% down to reduce the monthly payment.
Sure.
So there's a lot of variables that go into place, and that's why it's important that you work with a certified mortgage planner that's going to take into consideration all of those different things, not simply just give someone a quote with an interest rate based on purchase price and monthly payment.
And help you put that on a spreadsheet or an amortization schedule, and so that you can actually see
Correct.
where you're going to be at certain points in time.
Absolutely.
And that's pretty much out of the general public's purview to be able to have that kind of expertise, but you have that and can offer that.
Yes, absolutely. And I think where this comes down to educators is it's a fixed income, right? I mean, I know how much my wife is going to bring home to the penny every single 2 weeks.
Right.
So when you're working from a fixed income and you know that you're probably not going to have a substantial increase in income from year to year, you really have to put in place a solid plan that allows for you to do some of the other things that you need to accomplish.
Yeah.
Because owning a home is not where it stops. I mean, we have a daughter that we're wanting to save for college.
Sure.
Right. We've got retirement, and I would say we're amongst the masses of educators that are incurring the same type of scenarios.
Right.
So you don't want to just walk blindly into it and wake up one day and say, I think I'm going to buy a home today,
Right.
and run out and start looking. There's some thought that needs to go into it.
Or on the flip side of that, you get down to the end of the road and you go, well, what happened?
Yeah,
That's even worse.
that is true.
That's even worse.
Yep.
So we've talked about how do we get educators involved in this, and so how do we get our Indiana school leaders to help us move this forward for their staff?
Yeah, so again, I go back to that discussion that you and Tom had, and I think that the discussion was very accurate. There needs to be more financial wellness education that takes place, but I think that it needs to be financial wellness education that's pertinent to our educators and not simply from the investment side. Right. So I think that when you offer it from a comprehensive standpoint,
Sure.
it brings more people into the conversation. Getting people like ourselves and along with other advisors that are experts in their field, and getting them to do this collaboratively with their educators. I know how it is to have a 30-minute lunch and think the last thing I want to do is to walk down there to the cafeteria and listen to someone pitch a product.
Right.
It truly needs to be about education, not about selling something.
Yep.
And so I think that that's the first place that we start. I think the other thing too is just the conversation that we're having in terms of having those conversations with stakeholders in the school corporations, where you actually, where us as the advisors start to educate our stakeholders, our leadership at the school community level,
Sure.
In terms of what it is that we want to provide, that we want to come in and provide value to your staff.
Right.
We're not looking at this from a business development standpoint. We're truly wanting to come in and educate your staff on here are the things that you need to consider.
Sure.
And how to implement some of these ideas, some of these strategies.
Yep.
I think that that's where it has to start.
So I'm going to allow you to do a little bit of a commercial here.
Okay.
for those that may be viewing this or listening to this program. So
Sure.
How do school leaders get in touch with you?
Yeah, great question. So the best way to get in touch with me is simply giving me a phone call.
Right.
Giving us a phone call, sending me an email. Also, too, you can go to our website as well. That's Congressional Bank. Well, it's actually cbmindy.com. So that'd be another way to get in touch with us. But simple communication, I think that everyone has access to, either by phone or by email, text messaging, also LinkedIn,
right,
Twitter,
yep.
Instagram,
and
all of those different outlets.
If all else fails, certainly most of our listeners know me and know how to get a hold of me, so I can certainly direct them in your way. So again, this is Josh Shelton. He's with Congressional Bank, CBN.
cbmindy.com.
cbmindy.com.
You can, and you can call me by cell, which is 817-600-2117, or by email at that's the letter J, Shelton, at congressionalbank.com.
Okay, good. That's good to know. Been a great conversation with Mr. Josh Shelton, Congressional Bank, and I want to thank Mr. Shelton for being our guest on IAPSS's edition of Indiana Education Insight. Now, it's time to wrap up this episode with my take on the current state of affairs in Indiana education.
Dr. JT's closing comments.
Although you pointed out that accountability is still important, but there are many factors that go into preparing all students to become lifelong learners and contributors in the 21st century. As such, we need to begin to change the dialogue. We discussed the need for financial planning for educators, but we need to have financial planning ingrained into our curriculum to benefit our students as well. But with so much emphasis on testing that is truly meaningless, isn't it time to change the dialogue? Through this public dialogue, it is my hope that we can get our legislators and our state leaders to see the value of public schools and the nexus of promoting public schools and economic development in Hoosier communities. I see these as investments in our children and our state, not as an expenditure. Perhaps we can pursue this issue and others in another segment. On our next show, which is May 14th, we welcome Mr. Greg Simmons and Mr. Joe Ignatius from Matrix Integration, a premier technology company. Perhaps they can provide some additional insight into the State House and education. Join us for that and more on the next Insight into Indiana Education. Thanks for being part of education. Please stand up for Indiana Public Schools.